You hear about the big IPOs, but the real money is often made in silence. Discover the stealthy strategies founders use to sell their companies for astronomical sums, far from the public eye. In the world of business, the narrative of success is often loud and public. We celebrate the massive IPOs, the splashy acquisitions, the companies that go from garage startups to household names overnight. The media glorifies the founders who ring the opening bell on Wall Street, their faces beaming as their companies are valued in the billions. But what if this public spectacle is just one side of the coin? What if the real money, the truly astronomical sums, are often made in silence through deals so discreet, so stealthy, that the vast majority of the public never even hears about them? Today, we're going to pull back the curtain on the art of the quiet exit. We'll explore the sophisticated strategies, the hidden motivations, and the intricate processes by which founders sell their companies for billions of dollars, often without a single press release, a public announcement, or even a whisper in the financial news. This isn't about avoiding scrutiny. It's about strategic discretion, maximizing value, and controlling the narrative. Prepare to have your understanding of entrepreneurial success fundamentally reshaped, because sometimes the loudest wins are made in the quietest rooms. Let's unlock the secrets of the stealth billionaire. One of the primary motivations for a quiet exit is avoiding public scrutiny and market volatility. Taking a company public through an IPO is a grueling, expensive, and highly public process. It exposes the company to intense media scrutiny, regulatory oversight, and the unpredictable whims of the stock market. Founders become public figures, their every move analyzed, their every decision second-guessed. For many founders, especially those who value privacy or operate in niche, less understood sectors, this public glare is undesirable. A private sale, on the other hand, allows them to maintain control over the narrative, negotiate terms directly with a single buyer, and avoid the roller coaster ride of public markets. It offers certainty of valuation and a clean break without the ongoing pressure of quarterly earnings reports or activist investors. For example, a founder who has spent years building a highly specialized B2B software company might prefer to sell to a larger strategic buyer who understands their market, rather than trying to explain their complex business model to a skeptical public market. It's about choosing a path that prioritizes stability and control over public fanfare. The most common avenues for quiet exits are strategic buyers and private equity firms. A strategic buyer is typically a larger corporation that acquires a smaller company to gain access to its technology, customer base, talent, or market share. These acquisitions are often highly synergistic, meaning the acquired company fits perfectly into the buyer's existing business, creating immediate value. For example, a tech giant might acquire a small, innovative AI startup for billions, not for its current revenue, but for its groundbreaking intellectual property and engineering talent. These deals are often kept quiet until they are finalized, to avoid market speculation or competitive bidding wars. Private equity, PE firms, on the other hand, acquire companies with the goal of improving their operations, growing them, and then selling them for a profit, typically within 3 to 7 years. PE firms often operate with less public visibility than publicly traded companies, allowing them to make significant operational changes away from public scrutiny. They provide capital, expertise, and a clear exit path for founders who want to monetize their years of hard work without the complexities of an IPO. These buyers are often looking for established, profitable businesses that can be scaled rather than speculative ventures. The bedrock of any quiet exit is an ironclad confidentiality agreement, NDA, and strict non-disclosure. From the very first conversations, all parties involved, the seller, the buyer, investment bankers, lawyers, and consultants, are bound by legally enforceable NDAs. These agreements prevent any information about the potential sale from leaking to the public, competitors, or even employees until the deal is closed. This secrecy is paramount. A leak could trigger panic among employees, alert competitors to a potential acquisition, or cause customers to lose confidence. It could also drive up the acquisition price if other bidders enter the fray. Due diligence, the process by which the buyer investigates the seller's business, is conducted in highly secure, often virtual, data rooms, with access granted only to authorized personnel. The entire process is designed to be a black box, with information tightly controlled and disseminated on a need-to-know basis. This level of discretion ensures that the deal can be negotiated and finalized without external interference or market speculation. While IPOs rely on public market valuations, quiet exits involve sophisticated valuation methods and deal structuring. In a private sale, the valuation is often based on a combination of factors: revenue multiples, EBITDA, earnings before interest, taxes, depreciation, and amortization, discounted cash flow analysis, and strategic value to the buyer. This is a direct negotiation between buyer and seller, often with the help of experienced investment bankers. Deal structuring can be highly creative. Beyond a simple cash payment, deals might include earnouts, where a portion of the purchase price is paid out over time, contingent on the acquired company meeting certain performance targets. This aligns the interests of the founder and the buyer and can significantly increase the total payout if the company continues to perform well. Other structures might involve stock-for-stock exchanges, where the founder receives shares in the acquiring company or deferred payments over several years. These complex structures allow for greater flexibility, risk sharing, and can ultimately lead to a higher overall valuation for the selling founder, all negotiated behind closed doors. The art of the quiet exit is rarely executed alone. It almost always involves the expertise of specialized investment bankers and mergers and acquisitions (M&A) advisors. These professionals act as intermediaries, connecting sellers with potential buyers, managing the entire sale process, and providing crucial strategic advice. They have deep networks of corporate buyers and private equity firms, often knowing which companies are looking to acquire specific types of businesses. They prepare the company for sale, create compelling marketing materials, often called a teaser or confidential information memorandum, manage the due diligence process, and lead the negotiations. Their fees are typically a percentage of the deal value, incentivizing them to secure the highest possible price for their clients. For founders, engaging an experienced M&A advisor is often the difference between a good exit and a truly life-changing one, ensuring they navigate the complex process efficiently and maximize their returns. Finally, a critical yet often overlooked aspect of the quiet exit is post-acquisition integration and founder transition. A successful private sale isn't just about signing the papers. It's about ensuring a smooth transition for the acquired company and its founder. The buyer wants to ensure that the value they paid for is successfully integrated into their operations. This often involves a period where the founder remains with the company, sometimes as a consultant, an advisor, or even in a leadership role for a specified period, to ensure continuity, transfer knowledge, and help with employee retention. The terms of this transition are meticulously negotiated as part of the deal. For the founder, it's about ensuring their legacy, protecting their employees, and often setting themselves up for their next venture, whether it's retirement, angel investing, or starting a new company. The quiet exit allows for a more controlled and often more graceful transition, far from the public spectacle and potential disruption of a large-scale IPO. So, the art of the quiet exit is a sophisticated dance of strategy, discretion, and negotiation. It is a testament to the fact that not all entrepreneurial success stories are told on the front pages of business magazines. From avoiding public scrutiny to leveraging strategic buyers, from ironclad confidentiality to complex deal structuring, and from expert M&A advice to seamless post-acquisition transitions, these are the hidden pathways to astronomical wealth. Understanding these mechanisms isn't just for founders, it's for anyone who wants to truly grasp the dynamics of wealth creation in the modern economy. It shows that sometimes the most powerful moves are made in silence, away from the noise and the crowds. The question isn't just how to build a successful company, but how to exit it on your own terms, maximizing your value and securing your legacy. Are you ready to master the art of the discreet deal?